Hi, today I'm going to share with you how to invest in exchange traded fund ETF. So first question is what is exchange traded fund ETF? Basically, exchange traded fund ETF is a basket of the asset, can be the stock, can be the forex currency, can also be the bonds or commodities. So why is exchange traded funds? Why we need to invest in exchange traded funds? Exchange traded funds is best for the small account and then best for those no tie investor. Imagine that if your account is small, you does not have the money to buy a lot of the stock. So exchange traded fund is the best for you if you have a small account and is for the no tie investor to do. So we have to understand is what is the type of the ETFs. There's a lot of the ETFs in the market. We have the market ETF, we have the sector industry, bond, foreign currency, commodity, inverse ETF, and leverage. Among all these, only the one that I know suggest is the leverage ETF because this is a super high risk. Unless you are the professional, then you can try the leverage ETF. Market ETF is actually trading the market and then like S&P 500 Nasdaq. Sector ETF is a technology or healthcare. Bond is the government bonds. Foreign currency is the like US dollar, euro. Commodities ETF, inverse ETF is going opposite direction of the normal one. So we have to understand more about the ETF. So what is the ETF? The Nasdaq ETF, the ticker number is QQQ. So that you can just buy a QQQ means that you are actually holding Apple, Microsoft, Amazon, Facebook, Tesla, Google, Nvidia, Adobe, and Intel. So imagine that one Amazon share is about $3,000 now. So you does not have the money to buy one Amazon share. Maybe your account is only $2,000, but you can buy a Nasdaq index ETF is a QQQ. QQQ current price is only about 200. If you have 2000 account, then you can buy 10 share of QQQ means that you are holding a basket of the good companies at the same time. So this is S&P 500. The ticker number is SPY. The top 10 holding is also similar. It's Apple, Microsoft, Amazon, Facebook, Google, Johnson & Johnson, Visa, Puma and Camel. The difference between the Nasdaq and the S&P 500 is S&P 500 is more large because it has 500 companies inside the ETF. So these are some of the sector ETF that if you are interested, you can go and look at this. Then all these are actually from the sector spdr.com. You can just go and review this. You can see there is an industrial, energy, community, healthcare, real estate, technology, utility, materials, financial, and consumer discretionary. So what is the difference between the ETF and the mutual funds or the unit trust? So we do a simple comparisons. If you are buying the ETF, you can actually go long or go short. ETF is just like the stock, you can long and then you can short it. But if you are buying the mutual fund or unit trust, you can only long, you cannot short. Then the ETF is a continuous pricing, and for the mutual fund, the fund net asset value calculated at the end of the day means that the ETF that the pricing is like the stock is continuous. For the mutual fund, is they will calculate one, so it's different. So for the ETF, there is a low expenses ratio plus the broker commissions means that sometimes the ETF fund will charge you a management fee, but it is very low. It's only 0.1 to 1.2% only. Plus the broker commissions that you are paying once you are buying. Some of the broker I know there is the interactive broker or TD Ameritrade. They are actually offering the zero commission rate. So broker commissions is actually does not apply anymore. So but for the mutual fund or unit trust, actually they are have the sales charges once you buy. They will charge you 3 to 5% first, means that you haven't earned any money, then you have to pay 3 to 5% to their sales charges first. And then there is a yearly management fee that is 1 to 2%. This is yearly, so every year you are actually losing 1 to 2% just for the management fee. So the last one is the ETF is listed on the stock exchange, means that you can trade anytime that you like. as long the market is open. But for the mutual fund and unit trust, you can only buy through the bank or the insurance company. It means that every time you go to the bank, those bank's financial advisor or the insurance advisor, actually they are selling the mutual fund or unit trust. So here is the strategies for you to invest in the ETF. So first strategies is called dollar cost averaging, DCA. Imagine that you invest $1,000 every 3 months. So this is what will happen. So let's say beginning the price is $5, then you $1,000 can buy 200 shares. Then after 3 months, the price go out to $20, then you $1,000 can only buy 50 shares. Then after another 3 months, price come down to $10, then you $1,000 can buy 100 shares. Then it's like that continuously every 3 months that you buy. So what will be the result is after the end. So if let's say in this example you will spend about $9,000, then you will get about 610 share. 9,000 divided by 610, actual price per share for you is only $14.75 per share. So what is the profit? So let's say the current price is $40. So $40 minus you $14.75 per share. So your profit is about $25.25 per share. So times 610, you have about $15,400 profit by just doing the dollar cost averaging. Some people will think that this is just an example, may not be true. So I will show you the truth is. This is a S&P 500 ETF, SPY. So you can see this is my previous example, and then this is a real chart from trading view. You can see that the price moving, and then you can see my example is exactly the same, just that the price is not same. Price is just an example. How the market move is exactly the same. So you are just doing the dollar cost averaging. You can actually earn a lot of money. You just buying every 3 months, no need to care every day. So strategies two is buy in moving averages. So sometimes you don't want to buy too high, so you just wait. So what you can do is you can just add in the moving averages. So here are some of the moving average that I use: 50 MA, 100, 150, and 200 moving averages. So when do you buy? You buy in here. Once market drop, hit the 50 moving average, you buy. Go out, then you don't buy. Hit 50 moving average, you buy. Don't buy here. Hit moving average, 100 moving average, then you buy. Then here, don't buy. Even that you after 3 months, then you still don't buy because the price does not hit the moving average. Then come down, hit the moving average, then you buy around here. So some people may ask, I only buy, then when they are going to sell? Okay, for the long term investment, you are not going to sell unless you want to free out your cash to buy something like the car or the house. If not, you will never be sell. Or if you really want to sell, then you can sell when there is around here, this part. When there is far away from the moving averages, 50 moving average, then you can start to sell because price is always come back to the moving average. You can see here, go out, come back, go out, come back, go out, and come back. So you can sell when you feel the price is far away from the moving averages. So this is an example of the S&P 500 that lasts 93 years gain and loss. So everything here is represent a 30 years period. So here total have 64. You can see from this example that the average last 30 years, every years that you can actually gain about 12%. When there is a highest, maybe you can have 15%. Yep, the highest is 15%. The lowest is also 10%, but averagely is about 12%. So imagine that in the last 30 years period, every year you get a 12% return. So what will be happen? So we just do a simple financial calculator. It's a simple financial calculator. Okay. So number of period 30 years. Start principle. Imagine that you are just starting today. You got no money. Okay. So interest is 12% a year. So annual payment is 4,000 because just now I said that is 1,000 every 3 months. So 1 year have 4 quarters, so 4,000 a year. So after you calculate, your future value will be 1 million by just buying the ETF. 1 year's $4,000. I believe average everyone can do it, no problems. Just do it after 30 years, then you will have 1 million. This is just doing the dollar cost averaging. No need to look at the chart. Okay, if you like our videos, please like, subscribe, and open the notification so that you can receive our latest videos that once we upload. Thank you very much. Bye bye. See you.